Good afternoon, everyone. Welcome to another Federal Reserve balance sheet analysis with the live econ guy. So today I want to kind of discuss about recent trends, recent developments that have been happening in the economy. So some of the things that happened in June, which it currently is. We're getting close to the end of June 2023. Jerome Powell testified before the House committee, the Senate committee, and there was also an FOMC meeting during which he announced that he's kind of not raising the interest rates at that meeting, but he will be the Fed will be raising them about 2 more times this year. So kind of a hawkish pause, as some people call it. Next, guys, I want to show you what the balance sheet currently looks like. So essentially, let's zoom in to the current year, kind of the developments that have been happening. So at the peak, there was about $9 trillion in federal in mortgage-backed securities and U.S. treasuries held by the Fed. We're currently at around 8.36 trillion, and that's because, part of the reason is that there was this bailout that happened with SVB Bank and some other banks that failed recently. So that kind of erased about half a year of progress, of balance sheet progress that the Fed has been doing. Which takes me to my next topic that I'd like to discuss. It's this article called Bank Liquidity and the Dynamics of the Fed's Balance Sheet, posted in June of 2023 by the National Bureau of Economic Research. And I think it's a really interesting article because the Federal Reserve balance sheet, the mortgage-backed securities and the U.S. treasuries held by them, and the roll-off that's been happening. So essentially $35 billion every month being rolled off in mortgage-backed securities, and about at most $60 billion in U.S. treasury. That's been kind of on the back end of things. Nobody's been really focusing on that. Mostly people have been focusing on the interest rates and those being hiked, and that's how that's impacting the economy. But with these banks failing and overwhelmingly due to liquidity issues, the balance sheet is starting to be looked at a little more with a scrutiny, and that's kind of another thing is people are talking about it more, especially in the House and Senate committees that I've watched. And by the way, I'm going to link all of these down below if you're interested. By the way, I just want to remind everyone, the Fed, they're rolling off U.S. treasuries up to $60 billion a month, and that's pretty much once these mature, the U.S. Treasury pays that cash to the Fed. And with mortgage-backed securities, it's a little different. They're paid much more differently than normal bonds. So I made a video about this. They're paid over time, essentially, instead of just one giant payment at the end of the when the bond matures. But that part of the roll-off, those $35 billion at most, that's coming from the private sector. So that's banks that created these mortgage-backed securities. They're paying the Fed when customers or those who hold the mortgages actually make their monthly payments. So it's that part of the dynamic is a little different. And by the way, that $35 billion a month is never going to be reached the way things currently work. There's not enough not enough payments being made every month by those people that hold those mortgages to reach that. So it's going to take a long time to roll off those mortgage-backed securities unless the Fed outright start to sell these. So back to our article, this organization made this pretty nice chart. So they're showing bank deposits during various periods. So if you could see 2018 to mid 2019, banks are holding large amounts of deposits, and they're also expanding their credit lines that they issue to their customers. And then you have during the pandemic, lots and lots of QE happening and bank reserves falling because they're lending even more to their customers and putting a lot of money probably into the repo facility fund, so they are not paying fees on that. Essentially, if we just read this, in the wake of the global financial crisis of 07-09, the Federal Reserve embarked on an ambitious program of quantitative easing. So that's around right here. So lots of QE happening until like 2017. The Federal Reserve embarked on an ambitious program of quantitative easing, purchasing large quantities of bonds held by commercial banks and the rest of the economy. So commercial banks held a lot of mortgage-backed securities and U.S. treasuries, and those pretty much got sold to the Fed for cash. QE gave banks an infusion of liquidity by exchanging their longer-term assets for liquid reserves. On the liability side, however, these banks however, there was an expansion of demand deposit at banks, especially uninsured deposits such as checking accounts that depositors can withdraw from any time. Banks also responded by originating off-balance sheet liabilities in the forms of lines of credit. So pretty much banks got a lot of cash because the Fed bought their bonds, and now they have to do something with this cash. So they either lend it to customers and make money off of interest, or they put it somewhere like the repo facility where it's not going to be, where they don't have to pay fees on that, which allows businesses to draw funds up to a limit at their discretion. Both demand deposits and credit lines are claims on the bank's liability, and providing them without placing the banks at risk requires an appropriate stock of bank liquidity. So historically, if a bank issues a line of credit, they have to have at least like 10% or something like that of that total credit line available for withdrawal. So you can't just take all of your deposits and lend them out, because then you have $0 in deposits, and if someone comes into the bank and they say, I want to take everything out of my checking account, you don't have that cash readily available, and that can cause a lot of stress to the bank. So as the Fed expanded its balance sheet, banks, so we already read that. In 2017, the Fed reversed its QE policy and embarked on quantitative tightening. So the Fed allowed their balance sheet to start rolling off. You can kind of see that right here. So that was still under Jerome Powell. So this entire time, the Fed was just rolling off assets from the balance sheet, and let's read on. Shrinking its balance sheet by actively selling bonds for reserves, reducing Fed provided liquidity in the banking system. So once again, for mortgage-backed securities, that's pretty much what happened. Banks were pretty much paying cash back to the Fed for all the mortgage-backed securities that the Fed held. While banks expanded their issuance of claims on liquidity during QE, they did not rein in such issuance when the Fed shifted to QT. So pretty much what this is saying is, during QE, banks were lending a lot. They were essentially increasing their lines of credit, but during QT, which currently right now is happening, if you expand this chart, it's saying that banks continued to lend to customers even though the Fed entered a period of QT. Over time, as banks' reserves diminished with QT, so that's due to the roll-off in part, their ratio of outstanding claims on liquidity to reserves increased. So pretty much they have less liquid assets, but they have at least the same amount or more credit issued to their customers. In effect, the banks held constant the amount of withdrawals that depositors and firms could demand from them, even though their liquid reserves declined. This left banks vulnerable to episodes of liquidity stress in which many claimants demanded their money at one time, and banks have too little cash to satisfy everyone's claims. So that's pretty much banks being run on. So they give out too much credit, they have no cash, the capital requirements are zero. So people come to the bank and say, I want my cash, but banks don't have it because they lent it all out. Indeed, two such episodes occurred during the QT period in September 2019 and in March 2020. By the way, this is right when the pandemic started and the big QE happened, so that was very convenient. So let's take a look at what that's talking about. So that's pretty much this period right here. That's when the first kind of system started breaking due to assets rolling off, and kind of the second part of that is right here where the system once again broke. There was illiquidity, and the Fed just injected a lot during the pandemic, as they say. In both cases, the Fed intervened in financial markets to provide additional liquidity. Yep. Let's see, chronicled 15 years. So the researchers demonstrates using bank level data that increases in banks' central bank reserves during QE were associated with increases in the volume of demand deposits and credit lines. So pretty much as banks got a lot of liquidity from the Fed, by when the Fed bought their bonds, they had a lot of deposits, and because of that, they would lend a lot so they can make money off of their customers. But in contrast, they did not find that the banks that provided customers with more claims on liquidity during QE reduced these claims when QT kicked in. So once monetary policy switched to being tightened, so the Fed started running off their balance sheet and soaking money out of the economy, banks didn't really react to that, is what this article says. They continued to issue lines of credit, mortgages, etc., and kind of just recklessly doing that in a, so to say. This dynamics was particularly driven by less well-capitalized banks, which maintained their provision of liquidity claims to customers even as their reserves declined. So even as banks saw that their reserves are going down, they continued to lend. So the too big to fail, like, just keep doing it, I guess. These banks may have been less risk averse on the account of their weaker balance sheet provisions. Yeah, no, I mean, yeah, that's pretty much what it is. The researchers conclude that QE and QT are not mirror images of each other because primarily of how banks reacted to one and the other. The two policies change banks' liquidity-seeking behavior in different ways and differently for different banks. This asymmetry is also manifest in the recent failures of banks such as Silicon Valley Bank and Signature Bank that grew their uninsured deposit base during the pandemic QE, but did not decrease it sufficiently during the monetary tightening phase of 2022. So what this is saying is in 2022, when the Fed started providing that forward guidance of, hey, we're tightening policy, that's when these banks, Silicon Valley Bank and Signature Bank, should have said, okay, we're gonna slash some credit lines, we're gonna tighten borrowing requirements, and we're gonna start building our reserves. But they didn't do that. Obviously, they just left it as is. And such asymmetric bank behavior complicates the use of the Federal Reserve's balance sheet as a tool for monetary stimulus. Okay, so yeah, it makes it difficult for the Fed to go into QT mode because what they're doing right now, and I'm sure they know, is that they're making it really difficult. This part right here, they're making it difficult for these banks that are holding long-term assets and they're accumulating unrealized losses. So pretty much of these banks who are holding these low interest rate assets that they got during the pandemic period from 2020 to 2022, unless they can survive that and they have ample liquidity, they might have to sell that at a huge loss, or they might fail. So it's going to be an interesting episode here. Yeah, back to the balance sheet discussion. I think it's going to be really interesting how things continue to develop. Jerome Powell at his FOMC meeting said that the Fed is currently on a brisk pace of rolling off assets from the balance sheet, which I think is really interesting. He said to the tune of $1 trillion a year, but I don't think that's ever going to reach that level because of mostly for the mortgage-backed securities side of things. It's really slow. I've made numerous videos about this, the fact that it's never going to reach $35 billion a month, mostly due to very few refinances happening right now because a lot of borrowers are locked into very low interest rates, and also the fact that the aggregate, if you take everyone in the country and you count their monthly minimum payment on their mortgage, you're never going to reach $35 billion a month. Not even talking about the Fed's portion of that. So, yeah, I think it's going to take a much longer time to roll off those mortgage-backed securities. And to summarize, I think this article, which I'll link in the description below. I think it does a really good job kind of connecting the two, because as I previously mentioned, the Fed balance sheet roll-off has been kind of, nobody really asks about it. It just happens in the background. And then suddenly these banks start to fail. This Silicon Valley Bank and Signature Bank, they suddenly fail due to liquidity issues. And what is the Fed doing? They're soaking liquidity out of the system with their balance sheet. So yeah, I think there's a lot to watch for in the coming months, and I'll be providing more updates. So thanks for tuning in. Have a great rest of your day.